National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And on today's show, Indexed Annuities with industry index product expert, Sheryl Moore. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist, Steve Savant. Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of insurance professionals right out of Fountain Hills, Arizona, home of America's largest fountain. And with me today and yesterday and all this week is Sheryl Moore, industry expert on indexed annuities, index life, anything indexed, and it's not a security yet. Just a little point out there.
If I have my way, it never will be.
That's our goal. If you really feel like Sheryl and Steve are right about never making index products a security, we're going to start a blog. We want you to sign up.
Ooh.
You know, we should start a blog, co-blog.
I'm liking this.
And we're just going to say it shouldn't be a security. And think about it. The very little amount that's going in options on this is so small, right? I mean, we're talking, what, 3%? I mean, you know, guys, you know, I mean, the moment they said S&P, FINRA was all over it, you know, right? But we're getting better about this, and I think they are too. I think we're approaching it. We're trying to come to terms with the two bodies, FINRA and, of course, the insurance regulatory bodies, and they're duking it all out in Washington. They'll finally come to one way or the other. But right now, we're playing as a non-registered product, and I like that, and it gives access to all our agents to sell this, securities as well as non-securities. Now, when we were talking yesterday, we gave you a little history lesson. Oh, it was pretty cool. A little product lesson. Little opinionation from Her Highness. You know, she couldn't pass up a few places to go, and I think that's great. Today, we're going to start breaking it down. And the first thing out of the chute, I got to say this. Why do cap rates on indexed annuities are so much lower than life insurance? I get this one question on email. We send out the grid on indexed annuities, and they're like, what now? 2.5%, 3%,
3.32.
3.32. That's the cap for this year. And by the way, that could change from year to year, right? Okay, I'll get into that in a second. And then we're looking at the cap on the life insurance, the leading life insurance IUL.
It's 12% on average.
It's on average, but there is
17.
1%. There's 1% at 17.
Yeah.
And if they pay for this show, I will make sure they get the kudos for it. But I'm not going to bring them up because they haven't played their show. But I'll give you a hint. It's kind of like putting the scarlet letter on your. Okay, let's talk about Sheryl. Why can't I have similar rates? I mean, these aren't even close. 12% is the average IUL, and we're down at what, 3.32 on the index? What's with that?
Okay, this is so funny because it's the number one question I've been getting over the past year, and the funny thing is, to me, I think this should be something that everybody knows, you know, but. I just spoke with a guy who emailed me through Producers Web about 2 weeks ago, and he said, you know, I've been asking this question for 15 years, and you're the first person who's ever been able to tell me. Now, here's the deal.
True.
I like to call the index annuity cap like the pure cap, and I don't care if you're talking participation rates, caps, or spreads. They're all three different ways of doing the same thing. But people want to know, why are the life insurance rates on the index side so much more attractive? Well, here's the deal. With an indexed annuity, and with fixed annuities too, the insurance company has exactly one way to make a profit. Do you know what that way is?
If I tell you, will it blow your answer?
No, go ahead.
I think it's only on the expenses of the product. They're outsourcing all the stuff to an investment bank to make their money
spread.
on there. Their spread.
Yeah.
That's it.
I mean, the real easy way of explaining it is when you look at a fixed annuity, let's say you want to buy a 10-year fixed annuity. You give me $100,000. As the insurance company, I'm going to take that $100,000 and purchase highly rated 10-year bonds. Okay, I'm going to match the bond duration with the surrender charge on your product.
I'm assuming you're talking government bonds?
Yes.
Are they
very
still
conservative,
highly rated?
Safe.
Okay,
Nice jab at the United States.
15.3 million at the time, a trillion at the time of this show.
I know.
Okay, I'm just bringing it up.
Okay. Aside from the politics, we've got, let's say the bonds are paying 4%. We, as the insurance company, might credit a rate of 3% to your fixed annuity. What happened to the difference of 1%? Well, the difference between the 4 and the 3 is what we use to pay our expenses, pay a commission to the agent, and still make a profit. Okay? Now, with an index annuity, it's a little bit different because 97% of our monies, on average, could be 98, 96, is going to go into bonds, but the difference is going to go into options, and that's what provides the index-linked interest. Well, how does the insurance company make a profit on a life insurance product? Premium loads, policy fees, per thousand charges, cost of insurance charges, percent of fund charges. There are just so many different ways that an insurance company can make a profit on a life insurance product, whether it be UL or indexed UL. And so essentially we're kind of subsidizing those caps or those participation rates on the life side because we can put more money toward our options budget if we're able to make a profit through some of those other ways.
When I think about that, it sounds, I mean, at the beginning, we all think of index annuities and index life all fishing out of the same pool. Well, they are. They are. So when we're really talking about the mechanics, and here we're talking about moving parts on the life side that they have places to make money on. And I think when I come down to it, I have a major article coming out pretty soon here. It's beyond my white paper normal. It's going to be called Vapor on Paper. It's an attack on bad boy proposals and illustrations, right?
Good for you.
And the reason is because I'm just fed up with what we're pushing out there. And we'll get into this in tomorrow's show, 20-year look backs, 30-year look backs, and all kinds of rear view mirror thinking. And we're going to see if that really holds water. I just saw the Monte Carlo spreadsheet for the last 40 years, and I also saw the S&P all the way back to 28, and I started photographing 10-year increments anywhere I started and stopped. That show could be illuminating just in itself. I hate to keep PRing my future shows using Sheryl's clickability. You know, I love it. But really, when I'm looking at the differences, because right now we're down so low. Now, you say it could be caps, it could be spreads, it could be par rates, right? Let's go through each one, and I want to make sure we get it.
Yeah.
Let's do caps first because we were talking about it.
Okay. Well, let's just assume the S&P 500 over a 1-year period increases 10%. At the beginning of the year, it's at 1,000. At the end, it's at 1,100. Well, if I'm using a cap to limit the interest on the indexed annuity, and all indexed annuities must limit the interest. You know, we've got some folks out there.
Okay, why though? Why?
Because if I don't limit the interest, then I cannot afford to provide the guarantee, Steve. So in order to have that principal protection, we've got to limit the index interest. Otherwise, that's a variable annuity. You know, if you want unlimited gains, you have to have unlimited loss too. It's what I like to call the risk-reward trade-off. But with a cap on an index annuity, when the market's gone up 10%, let's say our cap is 8%, well then we credit 100% of the gain in the index subject to a limit of 8%. So if our cap is 8, in that scenario, the policyholder gets 8% credited. With a participation rate, same thing. We're just limiting the interest, but it's a different way of doing it. There's no cap, but let's say our participation rate is 50%. Well, the index went up 10% over the 1-year period, and if we credit 50% of any gains over that 1-year period, the policyholder is going to get a 5% interest credit. Spreads are the one that tend to trip some people up a little bit more. Spreads are not kept by the insurance company for a profit per se. We actually go out and buy the options and say to the option seller, look, I don't want to use a participation rate or a cap. I'm going to use a spread to limit the indexed interest. And a spread of, let's say, 3% in our scenario where the S&P 500 went up 10% would mean the policyholder gets a credit of 7% because 10 minus 3, our spread is 7% credit.
Well, some of the dialogue, I'm not saying it's the way I go, but some people like the spread only because, hey, we already know all the money for profitability, commissions, expense loads is all coming out of that spread. Right? So I pretty much know what my numbers are going to be like. But in the end analysis, and I don't want to get back to Wednesday's show a month ago because that caused so much controversy. I can't believe it, although it was total clickability, I have to say. I want to get back to this thing, Sheryl Moore, which is the best for the consumer. I got somebody watching. Remember, 13%, now I think about 13% of our show is watched by people in retail.
Okay.
So because of that.
Controversy.
I want to know. They want to know. I want to know. Caps, spreads, or participation rates, which one would you say is more consumer friendly?
Well,
I know this is a tough question.
Consumer friendly, I would say cap, just because it's the easiest to calculate, the easiest to understand. But for my advisors and my agents out there who say which is best, So funny, Steve. I get a million guys who say, I'm selling this product that has no cap and I know it's going to outperform all the others. Mm-hmm. Well, maybe it doesn't have a cap, but it has a spread. Right. You're still limiting the interest. Or maybe it doesn't have a cap, but some of the monies are being forced to be allocated to a fixed account. That's still limiting the interest. None of them are better than the other. Cap, spread, par. They're just three different ways of doing the same thing. Now, I will say, over the long term of the annuity, they're all going to average out to be the same. But in any one environment, will one do better than the other? Yeah.
Okay. Well, let's do the first part, which is Sheryl was on the show about a month and a half ago, and she said it doesn't matter. Caps, participation rate, spreads, it's all kind of games. And I got a lot of email on this. Right now, we're talking about this same thing again. But from a specific, there's no better numbers, you're saying, between a cap, spread, or participation.
Over a long term, no.
And that's what, 10 years or more?
Yeah.
Okay, so why is the industry confusing the customer or the client with these three options if it's irrelevant, because they're all going to have some kind of limitation?
Well, you're trying to get me in trouble, Steve, but let's talk about that.
I'm trying to get clickability.
Okay, well, initially, when the index annuity market first started back in 95, most product designs used a long-term point-to-point, or what I like to call a term endpoint. So we look at the S&P 500 in 1990, we look at the S&P 500 in 2000. We measure the gain over that 10-year period. Well, what's wrong with that if I'm talking about index interest on an indexed annuity? Because we credit gains at the end of 10-year period on any values that are left in the annuity. Well, every index annuity allows for 10% of the policy's value to be withdrawn each year without penalty. So if I have a 10-year annuity and the client takes out their 10% penalty-free withdrawal every year, at the end of 10 years, there's a big fat goose egg as far as the account value. And then when they credit the index interest, they get nothing. That's interest rate risk. That's inflation risk. I mean, that's just not smart. And so what we saw was a transition from those long-term point-to-points, because any index, S&P 500 or otherwise, has shown to have a greater propensity for gains over a long-term period. We transitioned away from that to annual reset crediting methods, like annual point-to-point, monthly averaging, monthly point-to-point, where we credit interest every 12 months. That way, if they want to take their penalty freeze, that's fine. Well, initially, that change was because of market demand and product, but let me tell you, caps, par, spreads, S&P 500, Dow Jones, all these different things have been created strictly for marketing.
So really, it's just name recognition.
Well, it's, hey, I want you, advisor, to sell with my FMO instead of this guy, because we have a product that does not cap the gains. We use a spread.
Wow. I love the controversy on that. It's still getting limited. And of course, if you're going to talk to any IMO, I hope you talk to Brokers Alliance. It's the Business Insurance Zone, the talk show that talks about insurance in your practice. You can write us here at the show's email address, thebiz@brokersalliance.com, or just call us 1-800-290-7226, my extension 147. Sheryl and I will be right back after a word from one of our premier providers of product right after the break.
Life doesn't always fit into 5-year increments. That's the standard for most term insurance policies. AG Selected Term offers you a powerful new way to help your clients customize their life insurance plans to anticipate known future events such as retirement, paying off their mortgages, or funding their children's college education. Buy only the term you need and no more. That's AG Selected Term from American General Life Company and the United States Life Company in the City of New York. Policies not available in all states.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, and financial color commentator. Before moving forward with any of the strategies or tactics we have in this show, whether it's caps, participation rates, or anything else, check with your CPA, as if they know, your attorney, or if you're FINRA licensed, your broker-dealer compliance department. There's a hit. And also, if you're going to go ahead and call us on any products like life insurance, annuities, LTC, DI, long-term care, group pension plans, 1-800-290-7226, extension 147. Hey, it's not what I know, it's who I know. That's why I have Sheryl Moore, industry-leading authority on indexing, whether it's life or annuities. But this week, it's all annuity. So, when we're talking about this, and people are going to be upset with this, because the next thing after we get out of caps, I'm going to be talking about, definitely going to have to talk about, hey, does it matter? 5-year, 1 year, monthly, daily sweeps, all the stuff that we hear. Now, you just said during the break, and remember, I try to restrict Sheryl from talking during the break because usually that's the stuff I want on the air, right?
Yeah.
That's the stuff I want her to talk about. But when we're talking about this, she says that distribution, she kind of attacked our little channel here. She goes, the distribution, we're kind of flagging this as saying, hey, we're the ones that saying no caps, and yet we have spreads, and yet we have participation rates. Okay, so somewhere, whether they cap it, par it, or spread it, they're limiting the amount, and they have to protect the guarantees,
yep.
And they have to make money on this. They can't just do this they're not a nonprofit. Okay, I get that, all right, and I'm willing to change my ways if you think that I, as an independent marketing organization, my sponsor, is doing the same thing as every FMO and IMO out there, because I don't want to be the same as everybody else.
Well, you have to look at supply and demand and what drives the market, and it doesn't just apply to insurance. I mean, if you think about it, when these products first started, they were 10-year point-to-point that used participation rates, and they were based on the S&P 500 alone. Okay, well, at that point, we were largely distributing through a captive or career distribution. Maybe some people were using PPGA, but the independent agent distribution was just being born, okay? And so initially, these FMOs, IMOs, NMOs, they're trying to develop their value proposition. Why should an agent do business with us instead of contracting directly with the insurance company or contracting with our competing FMO?
Sure.
And so what the FMO would do is say, hey, valued insurance company that we sell products for, if you really want us to increase our premium with you, what you'll do is develop a product for us so we can compete against this FMO who's selling a product by XYZ insurance company. So initially, if we had that 10-year point-to-point that uses a participation rate, let's say participation rates are maybe not that attractive, and that's what our competitor's selling. My FMO is going to go to the insurance company and say, why don't you develop a new product for me that uses a spread? That way, my spread is only 3%. That guy's participation rate is 50%. Maybe that sounds more attractive from a marketing angle, and I can advertise that better. Or, hey, this guy's using S&P 500. Give me something more exotic, like the Russell 2000, the Hang Seng, gold commodity. And it's really just, we've developed all these different ways of creating indexed interest opportunity. And in my opinion, and people, I know you're all for choices and diversification, but this is a product that you don't have to use market timing for. It doesn't have to be actively managed, and there's no reason for the complication.
Well, I mean, I'm just hearing you this. Basically, I'm doing the semantics to be marketeering and make it distinctive enough to pull me out of the pack. But now that we're kind of over that, since everybody's spreadsheets, I mean, when you see the index spreadsheets out there, and everybody, maybe we could rank them by all indexes that use caps, all indexes that use spreads, all indexes use participation. But bottom line, what if we made up a brand new division that actually absorbs all three? And by the way, if you heard it here, I want to partner on that. Because I'd like to do, here's indexed annuities and their limitations. And I don't care if you call it a spread, a participation rate, or a cap. Here's one thing from now on. This is the new grid. And that's the grid I'm going to use. And I don't want you to get mixed up as a advisor, and I certainly don't want our consumers to get mixed up on this. I want to understand what they're getting. And I want them to understand it simple. And my issue is, if we can break down the mechanics and make it simpler, and we're going into a whole nother controversy here in a second here. I want to be able to get this down so that we are true to our client. We understand it. We have a conscience here. I want to make sure this is done right. So the definitions are really meaningful to me, and I'd like to reduce it. I mean, my dream would be all carriers, let's figure out some kind of standardization and call it that.
Won't happen.
Won't happen.
In an independent agent distribution.
Right.
It won't, just because when you're an independent, my average independent agent is contracted with 26 different insurance companies and 6 different
That's
FMOs.
All? You should see our inventory.
6 FMOs.
Wow.
So, I mean, you've got to have a way of having this shiny, bright object to show the independent agent, so he'll contract with you instead of with your competitor, whether you're the manufacturer or the distributor.
What happens when you're as big as we are? We're a top 10 player in the United States. We got everybody. It doesn't matter who it is. Nobody's got some distinctive thing that they're out in broke. There's a few anomalies here and there, but I mean, broad brush. I'm making a broad, generalized statement. We have the vast majority, and the distinction we sell is never on product. It's about what we deliver. One of it is social media, HD 1080p video. We just have a lot of things that are going on in marketing that I don't know of any other. I mean, do you know of any other IMO? You traffic with these guys.
I'll tell you what. I have relationships with almost every distributor of index insurance products in the country. And I love them all. I love them all because what they're doing is trying to further my message about why people should know about these products, be educated on them, and consider them. But I will say, number one, you're looking at the fact that you guys do all this business and have all these carriers. Well, you're not just an annuity shop, Steve. Okay? There are a lot of FMOs who practice almost 100% annuity business. And so when you're looking at a commoditized product, and really index annuities have gotten to be commoditized.
Without question.
When you're looking at a commoditized product, you got to have a value proposition, okay? And the value proposition of a primarily annuity shop is not going to be the same as a life shop. So I think that that's never going to go away because there are quite a few FMOs that just sell annuities and much less else.
Well, let's do a small segue away from my distinctive feature of my IMO, pushing it on my show, to this issue of, hey, does it really matter if I got a 5-year point-to-point, annual point-to-point, monthly point-to-point? No, I'm daily sweeping.
Well,
is it going to make any difference? Is there one point-to-point that's better?
I will say this. From a consumer standpoint, it really doesn't make a difference over a long term. Here's where it is going to make a difference. The index, and I don't care if you're talking S&P 500 versus Dow or Russell, it has shown a higher propensity for gains over a long-term period, okay? And so for that reason, long-term point-to-point is really attractive. And certainly the caps and participation rates and spreads that are offered on those long-term point-to-points are much more attractive than the annual reset strategies like annual point-to-point or monthly averaging. However, I would caution my agents who think those long-term point-to-points are supreme. What do you do when you get to policy anniversary 1, 2, 3, or 4, and you have to explain to the policyholder why their account value did not increase due to index gains? And number 2.
So how do you answer that then?
Well, the answer is, remember, this is a 5-year point-to-point. We look at the S&P 500 on January 5th, 1990 and January 5th, 1995. So you won't see any index gains until the end of that period. But my second cautionary words to the agents who like those long-term point-to-points are, you better be allocating to an annual reset method, always, because, and it's fine if you like the long-term point-to-point. I don't care if you put 90% in there and 10% in an annual point-to-point or monthly point-to-point. But if your policyholder takes a 10% penalty free and you're using a 10-year product that only credits interest at the end of year 5 and the end of year 10, well, there's a lot of monies that are not going to receive index gains if the client's taking their penalty-free withdrawals.
Well, most people I talk to, they're saying that they think the market's going to be sideways. Why am I in a 5-to-5 at all? If it's going to be sideways, am I going to make any money off of that?
But the interesting thing is, Steve, we are seeing much more product development on those long-term point-to-point methods, and that's strictly because of our interest rate environment.
But that gets me nervous for the consumer, though.
Well, and I'm not going to remark on that yes or no. I think that the important thing is that this is something the consumer cannot differentiate or find the answer for themselves because we have kind of complicated the product as far as caps, par, spreads, all these different indexes, and all these different crediting methods. In the year 2000, I had 56 different crediting methods available on index annuities. Can you believe that?
No. How many is there now? I mean, is it reduced?
Well, last year I only had 12. Now I have 19.
So we're spreading out again.
And the reason is the low interest rate environment. Well, if I only have 12 different methods and the predominant method is annual point-to-point, but my cap is only 3.32%, how can I get the agent interested in selling my product? I can't. That 3.32% is still the reality, and it is relatively competitive when you look at the fact that CDs are only crediting 0.34% on average. But how do you say to the client, hey, if the S&P 500 goes up, you may get as much as 3.32%, but you'll never get less than 0. And that doesn't sound that awesome when I do have fixed annuities crediting rates as high as 4%.
Right. That's a problem. I mean, I see the actual consumer is now sitting there, a tale of two cities, saying if I'm willing to go 10 years, that's a long rate.
Yep.
If I'm willing to go to 10 years at a 4, that might be the way to go if you thought the market and the interest rates are going to be suppressed. But most of the people that we talk to in and out of our industry, and especially in the financial side, which we don't traffic in, all think we're going to see rates go up. And
3 to 5 years.
The rumor is, if rates start to accelerate out, index annuities may see a retardation or a slowing down of sales.
That's not a PC word anymore, Steve.
Oh, sorry.
But I will say, we're focusing too much on the caps, okay? This is not a product that sales are driven by rate. And fortunately for us, there's been one saving grace, and that is the guaranteed lifetime withdrawal benefit.
Well, we're going to talk more about this. We're going to talk about foreign and domestic tomorrow. We'll be all over this. Does that matter? It sounds like nothing matters that we're talking about here.
No, it matters.
Okay, we're broadcasting this show in 1080p. You can watch us right on our website, hit our red button archive for all this show and all our shows at www.brokersalliance.com. And, of course, all over our social networks, Vimeo, YouTube, Facebook, Twitter, and LinkedIn. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.